How do you know if a whole life insurance policy is truly set up for maximum cash value? We're going to go through exactly how to design a policy for maximum cash value in this video. We're going to look at some illustrations, some numbers, so you know exactly what to look for if you're considering a policy or if you already have a policy. Let's get into it. So with a whole life insurance policy, what many people are not aware of is that you, the policyholder, can actually choose where your money goes. Unlike most insurance products out there, whether it's a traditional term life insurance policy, auto insurance, any type of insurance typically has a benefit, meaning if it's a term policy, when I die, a death benefit is paid out, and that costs me a certain premium. And it is what it is. I pay that premium no matter what. However, with a whole life insurance policy, specifically when someone is interested in maximum cash value, you may feel that you don't care about the death benefit. We hear that all the time. You can choose where your money goes between these two areas. I can decide if my money is directed toward the insurance premium, which I'll refer to often as the initial insurance expense, or if your dollars are directed toward this PUA rider. PUA stands for Paid Up Additions Rider. I'll often refer to this, for simplicity, as a cash dump-in, and you'll see why in a second. So the premium, I like to refer to as the initial insurance expense. And then the PUA rider, I'll refer to as a cash dump-in. So if this is me paying money into a policy, I want to understand the relationship of these two areas. Let's assume that I want to pay in $100,000 per year. And if that seems like a big number, this can be $10,000 per year. If it seems like a small number, it can be $1 million per year. It's all relative based on the design of this policy. So any dollars that are directed toward the premium piece of a life insurance policy, with respect to the cash value, which is the point of interest to just about everyone we work with, premium dollars often result in zero or a very small percentage showing up in cash value in the first year and sometimes the first and second year. The reason why is premium dollars are primarily going to purchase a death benefit for me right off the bat. Now, as time passes, as I continue to make premium payments, if I fund it for a long period of time, premium dollars do build cash value over time. With a traditional whole life insurance policy, typically you'll find that premium dollars show up in cash value beginning the third year. Those begin then to earn the guaranteed rate, any dividends, I can access it, and it gets better and better as time passes. But the first 2 years, I'm behind the curve, nothing to show for it, doesn't look that good. Whereas these guys, this PUA rider, which I like to refer to as a cash dump-in, anything I pay in here, guess what? Shows up in cash value. That's money I can access right away. Begins to earn the guaranteed rate, begins to earn dividends. This is the key to maximizing the cash value, both on a guaranteed and non-guaranteed basis from day one and throughout the life of the policy. Now, it will purchase me some life insurance. Typically, it is a very small amount compared to premium dollars, but it does purchase me some death benefit. However, just about everyone we work with primarily pays money in here to this rider right here for the cash value benefit. So naturally, the follow-up question we get, let me ask first, what's your follow-up question as you see this? If you want to pay in $100,000 per year, and you can choose how much of that $100,000 goes toward the premium and how much goes toward this PUA rider, where would you like to direct your money? Well, the question we get frequently, the question I had when I was brand new to all of this, almost 10 years ago, the question my father asked me the first time I was looking at these numbers was, can I just put everything into the PUA rider and zero into the premium because I don't care about the death benefit? The answer is not quite. There are minimums that are set by two institutions or two large entities out there. One is the insurance company that we're working with. We see this 10x limitation right here. What this means is whatever your total payment is, typically you can drive the insurance premium piece as low as 10%. You'll see that to be the case with many of your major mutual companies, like a Mass Mutual, Guardian, New York Life, or Northwestern Mutual, the big four in the industry. What this 1090 refers to is if I'm paying in $100,000 per year, I can set the minimum premium as low as $10,000 per year. And then I have the ability, not commitment, but ability to throw another $90,000 per year into PUAs, which helps accelerate the cash value growth. And I see a cash-rich policy from day one throughout the life of the policy. So why I like to ask that question, how much do you want the ability to pay into a policy on any given year, is because it helps us determine what your minimum will be. Think of it this way. If you said, hey, I want the ability to put in up to $100,000 per year, knowing that the insurance company will allow you to 10x that minimum base premium, I know I need to set the minimum premium at least $10,000. If you said, $100,000, Steve, that's way too high, I'm looking to pay in $10,000 per year, well, then we would set the minimum premium at 10% of that total desired payment, which would be $1,000, which now allows you, the policyholder, to commit to that minimum $1,000, and then at your discretion, you can add more funds up to a total of $10,000 per year. So what's really nice about this is it really allows you to take a life insurance policy, when set up properly, as a safe, liquid, tax-free area to position your money. It allows you to take that life insurance product and turn it into a flexible savings asset, in the sense that you can commit to the minimum amount only and just pour excess funds into the policy anytime you want. But what we want to be aware of is that limitation that is set by the insurance company. This way we don't go too low in the minimum. Meaning, if things go very, very well and I want the ability to pay in $500,000 per year, I can't have a policy with a $2,000 minimum premium. It would have to be at least $50,000. So good to have awareness on that. But with respect to the limits, the insurance company will often allow you to 10x. That is not the case of all insurance companies out there. And in fact, even your major mutual companies have different limits that are all very close to that 10x multiple, but they do vary a bit. So when we're working with anyone, as we look at different companies, we're going to be very transparent and show you the exact dollar figures. This way you know exactly how low you can go with the premium. So first limit, insurance company limitations. Second limit to be aware of, IRS limit. So we've got this MEC limit here. MEC represents Modified Endowment Contract. Any life insurance policy can become classified as a modified endowment contract. If it does, the cash value growth is still tax deferred, but anything you access, you have to pay ordinary income tax on the gains, and then also a 10% penalty on the gains if you touch it prior to the age of 59 and a half. To summarize, we don't want a MEC to occur. It strips the cash value of that tax-free benefit. So how we prevent it is every policy has what is called a MEC limit. Now the fun part is that we can actually set that limit wherever we want. You have control of that when we first set up the policy. If you want to get very technical, what you'll find is that the measuring stick that the IRS uses to determine that MEC limit really is based on an individual's age and total death benefit. The guaranteed rate and gender with a life insurance policy does have a play as well, but the main factor or factors is an individual's age and death benefit. But in most cases, if someone said, hey, I want the ability to pay in $100K per year, what we're going to do is set that MEC limit at or above $100,000, the minimum premium at $10,000. So setting that at $100,000 allows us to set the death benefit at the lowest amount possible, which helps us minimize the costs as much as possible. This way you've got more cash value. Fun stuff, right? Fairly technical. Let's look at a couple of examples here. So as we look at the charts here, we've got 3 different policies with 2 different companies. So company A, 1 option, and then 2 options with company B. So before we just start looking at the numbers, or first, let me add this. Here's what to look for. Just for simplicity, you've got $100,000 per year going into these examples for 5 years. This is based on a 40-year-old male. And here's the key indicator to know if a policy is set up for maximum cash value from day one. Of that $100,000, you should see anywhere between 80 and 90% of that payment in cash value in the first year alone. That is the key indicator. Now, depending on the company, the product, how they actually credit dividends to the product, will have an impact on long-term performance. And this is where we like to compare and contrast, show a number of options. This way, the policyholder, if it's you, can really select the option that you know is best for you and will complement what you're trying to accomplish as the years pass. But as we look at these options, here's what I want to touch on. So, where is your money going? So going back to the whiteboard, money can go where? Toward the insurance premium or toward PUAs. Premium, insurance expense, PUAs, cash dumping. Where do I find that on an illustration? Here's one company. This guy represents the premium. We see that it is set at $10,000. Where I came up with that number is here we've got $100,000 per year going into the policy. Of the 100K, 10,000 is directed toward the premium. Everything else is directed toward PUAs. I'll rephrase. We do have a little over $1,000 directed toward a term insurance rider as well. The reason for that is adding term insurance is a way to increase the death benefit. And when one says, well, I don't care about the death benefit, what that has a direct relationship to, the death benefit, is what? MEC limit. Age and total death benefit have a direct relationship to the MEC limit. So if I want the ability to pay in $100,000 per year, I need a MEC limit of at least $100,000 and a minimum premium of at least $10,000. So that's where we came up with the examples in this chart. For this illustration, there's your total cash value column, 92, 115. That'll match the Excel spreadsheet. If we look at the other example, here we go. Where's the money going? So we see a total of $100,000 going in. This is one of the major mutual companies. Here's the premium. Look at this. $9,090. Where we came up with that number. Here's your PUA payment. The PUA payment is 10x the base premium. So technically in this example, we can 11x our base premium with respect to a total payment each year if we wanted to go that aggressive. Doesn't make a huge difference, but that just demonstrates the examples between different companies and products where some are 10x, some are 11x, some are a little bit less. Depends again on the company and product. But here we see payments going in. $100K per year for 5 years. Nothing thereafter. That's your actual out-of-pocket. Net cash value, year one, $83,000 and change, almost 84. Break-even point in this example, year 5, where I've paid in a total of $500,000, and I have $500,000, 502 to be precise. So there's a couple examples there. Going back to the Excel spreadsheet, which simplifies everything. We've got it side by side. Company A, there you go. Cash value, $83,733. Between years 4 and 5, really year 5 is the break-even point where I'm cash on cash. After that, I pay nothing in. However, I can continue to do so if I want to, and the cash value continues to grow. Then we see company B, option 1. It's fun stuff, isn't it? $100,000 per year for 5 years. There we go. $86,000 right off the bat. Breaking even, also year 5, between years 4 and 5. Here's option 2 with company B. All of these are funding for 5 years, which mainly demonstrates a short funding period, as many people are attracted to that. However, if one states, well, I want to fund longer than just 2 years, can I continue to pump money into it? The answer is yes. Here's option 2, or I should say option 2 with company B, where you see it's the exact same product. This was actually the illustration we started with, the detailed illustration. You'll see through the first 5 years, everything's identical here. And the only difference now is that the individual stated, I'd like to continue to pump money into the policy because I still have money to pay in. Whether it's 100,000, whether it's 10,000, whether it's 50,000, the nice thing here is when we design a policy for maximum cash value, if you're still paying into it, if you still want the option to make payments, we still have to pay our minimum premium. If we make the minimum premium payment, then you still have the ability to make additional PUA payments. If you don't pay the minimum premium, typically you cannot make additional PUA payments. So if someone says, I'm not sure if I want to stop funding after 5 years, how do I continue to keep the option open to pump money in? The answer would be you have to continue to pay the minimum premium in that case, and then you can add additional funds on top of it. So I hope this one was helpful. Hope you had as much fun as I did with this, talking about policy design. If you have any questions, please feel free to reach out. You can call, email us anytime. And as always, I hope this helps. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.